This error is actually essentially a bug, a code error. I think the crypto market has been limping along since October 10th because on that date was a negative shock. Today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. They act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling.
The discussion begins with a comparison to NVIDIA, a stock famous for massive price swings following earnings. But Lee quickly shifts the focus. Markets today echo the same stress signals we saw on October 10th, the day crypto suffered an enormous liquidation shock. According to Lee, Bitcoin has acted as a leading indicator for equities, showing weakness before stocks rolled over. This isn't random. Bitcoin often reacts first because it trades in what is perhaps the last true free market, 24/7 global liquidity without circuit breakers or regulatory guardrails. And that brings us back to the catalyst, the October 10th shock.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
This is, by the way, not unusual for NVIDIA, is it? NVIDIA, the good folks at Bespoke, your team, you've recognized that NVIDIA will often have these kind of wild swings following earnings, but what is your take right now on these markets?
I think the crypto market has been limping along since October 10th because on that date was a negative shock. Today's stock market looks a lot like an echo of what happened October 10th. But on October 10th, that liquidation was so big, Brian, it really crippled market makers. And our market makers are critical in crypto because they provide liquidity. They act almost as the central bank in crypto. And if they've got a hole in their balance sheet that they need to raise capital for, they need to reflexively reduce their balance sheet, reduce trading, and if prices fall, they've got to then do more selling. So I think that this drip that's been taking place for the last few weeks in crypto reflects this market maker crippling. And so in 2022, it took 8 weeks for that to really get flushed out. We're only 6 weeks into it. So I kind of concur. I think crypto, Bitcoin and Ethereum are in some ways a leading indicator for equities because of that unwind and now this sort of limping and weakened liquidity.
Well, that was the point that my very, very smart team behind me, we put together for the top of the show, which was showing that Bitcoin turned down today before the market did. All right, take us back. So October 6th, I think it was October 6th or 7th, Bitcoin hit 125,000. Yeah, a couple days later, it was still around 120,000. Now, obviously, Bitcoin's at 86 and change. So what specifically occurred on or around October 10th that would lead us to where we are now on what, November 20th?
Yeah. Well, Steve actually pointed this out. There's a lot of what they call automated processes in crypto. One of them is called ADL, okay, and that's an automatic liquidation feature that would take place if someone's account or their collateral drops in price. It's essentially like a margin call. On a specific exchange, a stablecoin's price varied from other exchanges. Stablecoin should stay at $1. It dropped to 65 cents. But that only happened within the exchange quotes, within this exchange because of liquidity. That triggered an ADL, an automatic liquidation across many accounts. It wiped out, as that spread across other exchanges, right? Because liquidations cascade, almost 2 million crypto accounts got wiped out, even though minutes before they were actually profitable accounts.
So who is behind this? Like, who's the they in the market makers and they got hit? Who's the they?
Well, Brian, I am aware of names, but because I'm not someone who wants to name names, I think what you should keep in mind is that this error is actually essentially a bug, a code error, because I think in retrospect, they would have pulled pricing from across exchanges to set the price for that stablecoin rather than rely on internal quotes. But this has resulted in a lot of market makers and traders having less capital. And as you know, as crypto prices drift lower because trading volumes drop, they need to then have more capital available, which means they shrink their balance sheet further. So this is then that reflexive weakening.
I want to go back to this point, Tom. I hate the term glitch. I can't stand the term glitch because, things go down at the airport and they say, well, a glitch caused your flight to not take off. That's not a glitch. That's more than a glitch. It's a word that is used to describe pretty serious automation issues, software problems, crashes, for some reason that they try to minimize. Is this some kind of a software bug that's causing part of this? I'm trying to follow exactly what you're hinting around about.
Brian, it is. For instance, in 1987, portfolio insurance was the, quote, glitch. And that triggered the cascade in 1987. And so the industry learned and then never offered that again. In 2009, it was really the collateral wasn't secure in real estate in these packaged subprime mortgages. Now, the industry learned and they recoded that. I'm talking about Wall Street, but then regulators came in and overregulated. That was the negative effect of that. In crypto, this code of ADL and the way they pull prices is never going to happen again. The good news is we're not going to have overregulation in crypto, but now we have to deal with that liquidation effect. 2022 was a big liquidation, and it took 8 weeks. But that is kind of, you're right. It is the nature of DeFi where there is going to be code and there's going to be an error found. And you said it, leverage is what's dangerous. And so investors should not be using excess leverage in crypto.
The federal funds rate sits near 4%, but estimates for the neutral rate hover around 3 to 3.6%. This means monetary policy is still restrictive. The economy remains under pressure, risk appetite stays low, retail remains squeezed. Even if the Fed cuts 25 BPs in December, which is a coin toss, it still isn't enough to cross below the neutral rate. To reboot the full risk cycle, especially retail participation, Lee suggests 2 potential triggers. However, he defends Powell's record, arguing he did what needed to be done to avoid runaway inflation. Only after the recession and liquidity wave did markets enter a massive bull phase. Lee believes we may be in the same pre-breakout compression, waiting for policy to loosen and liquidity to return.
The problem this cycle is that Main Street has been hurting. People, just everyday people that run businesses, that go to work, that maybe aren't as interested in investing, but they still contribute a lot to society, right? It's like the backbone of society. They've been hurting, whether it's due to inflation, whether it's due to AI fears, whether it's due to higher for longer and tighter monetary policy. Who knows what the reason is? But when you look at the price of Bitcoin, there's an interesting metric you can look at, and that's this one right here. It's the ISM. Now, what is the ISM? The ISM, you can see here on this website, so we're looking at the United States ISM Manufacturing PMI. It's the manufacturing purchaser manager. It's the purchasing managers index, right? It's a purchasing managers index, and if it's above 50, it means that we're in expansion. If it's below 50, it means we're in contraction, and it indicates just overall the health of the economy. And so what you'll notice is that over the last say 10 years, there's been periods of boom times and then other periods where it goes through a bust phase. But what's interesting is when you look at the price of Bitcoin and you overlay the ISM onto the chart, what do you see? What do you see? You see pretty clearly that major peaks by Bitcoin have corresponded to peaks in the ISM, right? You can pretty clearly see that. Clear as day. So the reason why, when you look at something like the social interest, the reason why it's effectively been zero this cycle, Main Street's hurting. That's why this why the cycle feels so different. Right? That's why there hasn't been any euphoria, because Main Street is hurting. And you could argue the reason why the ISM is staying below 50. You could argue it's because the Fed funds rate is still higher than the neutral rate. The Fed funds rate is currently at 4%. The neutral rate, some people think it's as low as 3%. No one really knows. I tend to take the 2-year yield as a good approximation, which is around 3.6%. You could argue that if the Fed were to come out and cut by 50 basis points, we'd be below the neutral rate. But they're probably not going to do that. In fact, if you look at expectations for what the Fed's going to do in December, last I checked, it was a coin flip. It's a coin flip. And even if they cut 25 basis points, that's still not enough theoretically to get below this abstract neutral rate, because it's at the 2-year yield's at 3.6%, and some people think it's below 3.6. Some people say it's at 3. No one really knows, but that's why when you think about that comparison we made in, I'm sure you guessed it, 2019, what happened? What happened in 2019? We had a top, but retail never came back because Main Street was hurting. And then we had a recession, a pandemic-induced recession. The money printers turned back on, and Main Street came back. Retail came back. So you could argue that we are doing the same thing. And what we need to really get things moving again is a scare that would allow for much looser monetary policy, or simply for Jerome Powell to be replaced as chair of the Federal Reserve. Now, I'm going to say something controversial, but I don't think it should be. But it's my channel, so I will say it. I think Jerome Powell's done a pretty good job. How do you blame him? The S&P was just at new highs not too long ago. If you had done what his critics would have said to do, you would have been cutting rates back in 2022. So I think Powell did what needed to be done, frankly. Now, could they start cutting rates more now? I think you could argue that. But I also don't think you can look at what Powell did over the last few years and criticize him too strongly for it, right? Like, he did what he thought he needed to do. And yes, it's caused some pain, but what was the alternative? Just cut rates to zero, print money, and have milk cost $10 a gallon? I mean, like, what, what's the alternative there? So I do wonder if we're going to go into a period, where there's like a little bit of waning interest as we get into early 2026. But as interest rates come down and monetary policy starts to change, you could end up getting sort of that next phase of the business cycle. But we're not there yet, right? Like, you could argue that this 2019 top on the ISM was basically the same as the one we got in 2025. And then it went down. There was a big scare, and then everything changed. So if you keep going back to this idea of like, why does it feel so different, right? Like, yeah, Bitcoin did what it always does. Bitcoin, if you look at the ROI from the low, what more could you have asked for this cycle? In fact, if I had asked you 3 years ago to draw out a potential path for the market cycle ROI, is there not a chance you would have drawn out exactly that purple line? But yet we sit here and say, well, why does it feel so different? It feels so different because only the blue chips rallied. The other stuff didn't rally. The other stuff didn't rally because Main Street is hurting. And Main Street, more retail investors, are what send the riskier stuff higher. When you're more so focused on institutions and all this other stuff, that's when the blue chips do better.
According to Tom Lee, the post-October 10th downturn wasn't driven by weak fundamentals, but by a major structural failure in crypto's automated liquidation systems that temporarily crippled liquidity across exchanges. Combine that with high interest rates, suppressed retail sentiment, and ongoing Main Street pain, and it becomes clear why this cycle feels so unusual, even though Bitcoin's performance aligns perfectly with historical patterns. The takeaway: we're still in the middle of a liquidity repair phase. As market makers recover and monetary policy eventually loosens, the next phase of the crypto cycle could ignite far more dramatically than what we've seen so far.